Silver has confirmed its recent breakout, moving over the next highest resistance level this week. Meanwhile, platinum has busted a move. It is up 45% in the last 10 weeks alone. In this gold market commentary for Thursday, June 19th, 2025, we'll take a look at what's been happening with all four of the precious metals, review briefly some of the latest U.S. economic data, and offer to you three fantastic specials that we have in the physical precious metals market arena. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. If we can help you with any of your needs in the physical precious metals arena, whether you're buying or selling, we'd love to have that opportunity. Let's take a look at what's been happening with silver. In our last update, I showed you with this very chart how silver had broken over the first line of resistance at 34.93, punching up as high as 36.35, indicating that a tentative breakout was on the way, but it wouldn't be confirmed until silver actually broke over the second line of resistance at 36.89. Well, it did just that this past Tuesday, punching up as high as 37.27, after brushing right up against 36.89 about 5 trading sessions earlier. So silver has now confirmed by moving over the 36.89 resistance level that this breakout is indeed for real. But I don't see silver racing higher in the short term. If you look at the 1-year silver chart, you'll see that silver has been moving solidly higher. It's up 23% on a 12-month rolling basis in a stair-stepping fashion, primarily 2 steps forward and 1 step back, 2 steps forward, 1 step back. So now we've got the latest 2 steps forward. And as I tape this today, silver's about 36.50. So it's coming off just a little bit. I don't expect to see, as some have indicated, a major short squeeze rally popping this market substantially higher quickly. This market is grinding higher in a stair-step fashion. Now, a sharp rally is indeed possible, but I think we're going to continue to see what we have been seeing is stair-stepping higher, 2 steps forward and 1 step back, which means when you get the 1 step back, that is your buying opportunity. And this market is looking very solid to me. If we look at the gold to silver ratio chart, the silver run higher with gold moving primarily sideways over the last couple of weeks has moved that ratio, which peaked at almost 105 to 1, down to 92.2 to 1 today, with gold at 33.70 and silver at 36.55. I believe that this ratio has the chance to narrow closer to the 82 to 1 level, which would bring the silver price up towards $42 to $44 an ounce, depending upon where the gold price is, which is indeed our next target level that we're looking towards for silver. The next higher resistance point is at 43.70, which is the height that it reached after that last all-time high at 48.60 in 2011 when it bounced before it continued its downward trajectory. So I think we're going to continue to grind higher in a stair-step pattern like we have done for the last 2 years. And silver has really made a nice move higher from about 24 now to just under $37 over the last 2 years, following gold higher, but lagging. Gold has been leading and silver has been lagging, but now it's getting the opportunity to play catch up. I just don't feel like the market is right for it to play catch up with a vengeance just yet. But this is another solid move higher for silver. And I would expect over the next couple of months, we'll see it continue to grind higher until something triggers it to really run sharply higher, which is entirely possible. So buy the dips in silver when you can. On the 1-year gold chart, gold is up 45% on a 12-month rolling basis, which is a big, big gain for gold. We've got a double top now at 34.34, and we've got a rising bottom over the last couple of months since the Liberation Day shakeout. So I see a trading range between 31.85 and 34.34 with a rising bottom and a flat top. That usually leads to a breakout higher. And now we've got Israel and Iran at war, which should lead to a higher gold price. It hasn't so far. I don't really want to talk about how this big conflict is going to affect the gold price because nobody knows what will happen next. I know what I think will happen before this conflict is over, and I'll talk about that at the end. But regarding gold, the fundamental pattern looks very solid. Got a rising bottom and a flat top near the top. So I do think gold is going to move higher over time and get into $3,500 above that, towards that range and above it. And I still think that we have a $4,000 gold target in sight before this year is over. So gold is looking very solid right now as it moves in time. Meanwhile, platinum has busted a move. In the last 10 weeks, it has moved from right about $900 an ounce to $1,319 an ounce. This is a gigantic moonshot higher for some very strong fundamental reasons, which we'll explain in just a second. Platinum has broken over a 5-year resistance point at 1275, which means we have to widen the chart out to take a look at where we've been in the past. But first, let's take a look at some of the fundamentals underlying this big drive higher for platinum, punching it over the latest resistance level at 1135 all the way past 1275 to 1319. Bloomberg reported in late May that China imported the most platinum in a year as a squeeze in the physical market has tightened. In April, China imported 11.5 tons of platinum, which is equivalent to about 370,000 ounces. If you look at the available supply of physical platinum in the NYMEX market for registered and available platinum, it's about 350,000 ounces today. So China imported more physical platinum that is available for delivery in the NYMEX market in April alone, which is one of these drivers for the platinum market, moving it so sharply higher. A gigantic surge in physical demand. Now, some of this is being chalked up to China wanting platinum for jewelry. The Asian market loves gold jewelry and platinum jewelry. And with the platinum price being fully 1/3 up until now, the price of gold and gold becoming pricey in Asia. And I've explained in my previous videos how Asian buying drove gold from 3,000 to 3,500 when tariff turmoil hit. Well, now they're looking towards platinum as a metal to be used in jewelry, among other things. That's one of the drivers. But this is a very huge surge of physical demand, and it's the most fundamental price driver that you can have in the market, physical demand. So this market rally for platinum looks really good, but it could be a bit volatile. Let's get into that in just a second. In the meantime, corroborating the platinum move higher is a big spike in lease rates. When lease rates, or the premium you pay to rent the metal, spike, that means there's a big demand for physical platinum in the marketplace, which corroborates this move for platinum higher. And today, lease rates are approaching 15%, which is sky high for a precious metals lease rate. This means that there's a big, big squeeze in the immediate delivery platinum market right now. So this is a corroborating sign that this platinum move higher is for real. But when you back out and look at a 15-year platinum chart to see where we've been over the last 15 years, kind of like silver, this level between 1150 and 1300 for platinum is kind of like silver between $35 and $37 an ounce, in my opinion. It's nice to see the metal move over it, but you really got to get over the second level to signal a true breakout. The level between 1150 and 1300 is kind of no man's land. And when you see a market move this far, this fast, so violently higher, there's normally somewhat of a commensurate violent reaction to the downside as speculators pile in on momentum and then they pile out taking profits when the market starts to turn. So I would expect platinum, unlike silver, to have some real volatility in the next couple of weeks, depending on whether it can hold over 1300 and move into that 1300 to 1500 range or not in earnest. If it can't do that, then expect some volatility and perhaps a pretty sharp correction down towards that 1150 range. I do think the platinum market looks really good. I would buy it if we got under 1200 in the 1150 range, to be honest with you. But right now, I'd be a bit cautious because it's made such a big move higher. And of course, we've got this war going on now that could confound things. So be careful with platinum, but this market move higher looks for real. I continue to believe that palladium remains fundamentally a sounder metal to buy because it's scarcer and its industrial use is higher in gasoline catalytic converters, where platinum is used in diesel catalytic converters. So palladium will have higher industrial usage. It's at a lower price today at about $1,075 an ounce. It could move substantially higher as well, but palladium's Achilles heel is that it's much more brittle than platinum, and its look is closer to silver. So it's not appropriate for jewelry. It's much, much harder to make, and it also doesn't look that much different than silver in the long run. So that's why platinum has that kind of cachet, especially in Asia, for jewelry. The palladium never will. And I think that's the fundamental difference right now in the marketplace between the two of them. So that's our metals section. Moving on to the US section, we see the dollar continue to be weak. We had that massive head and shoulders pattern, which led to the cyclical low of 98.28. And now we've seen a second short-term head and shoulders pattern that's led to another new low for the dollar on the US dollar index of 97.92. But we're getting just a bit of a rebound in the past week alone, which I attribute to that Iranian-Israeli conflict. So the dollar's catching a bit of a safe haven bid right now, but I do think the trend for the dollar remains weaker, which will help to buoy precious metals prices as we move forward, especially if the Fed is forced to cut rates going forward, which I think is inevitable. It's just how much will they cut and how fast and how far will they cut. I do think the U.S. economy is looking pretty tentative at this point in time, with more economic erosion going forward. So let's take a look at why. Well, employment is one of the main drivers of the U.S. economy. It's the most fundamental factor that underpins it. And right now we're seeing unemployment claims, both for initial unemployment claims and continuing unemployment claims, continuing to rise. They're trending higher. This is not a good sign for the U.S. economy. The jobs market is weakening, with people being laid off in higher fashion and people who are looking for jobs remaining unemployment ranks, and those unemployment ranks are growing. So fundamentally, higher initial unemployment and continuing unemployment claims is not a good sign. We are seeing inflation perk up just a tiny bit, with headline consumer price index inflation edging 0.1% higher in May, while core CPI holds steady as the first ripples of the tariff increase to 10% across the board are actually starting to hit the economy. Remember, most tariffs have been put on hold for 90 days starting April 9th. That takes us to July 9th. So it's a couple more weeks. We might have some clarity on what these tariffs on every individual country might actually be. Maybe the can will get kicked down the road again. That's anybody's guess. But right now, we're starting to feel a little bit of that in the marketplace. In other signs that the U.S. economy is weakening a bit, We've got U.S. retail sales dropping for the second month as tariff anxiety sets in, and U.S. industrial output declining for the second time in 3 months. So retail sales are easing, and we've got industrial output declining and manufacturing weakening as well, which are signs that the U.S. economy continues to erode as time passes. So I think it'll be inevitable that the Fed will be cutting rates at some point in time in the future, and perhaps sharply. But for now, they're holding steady, as they just announced in their conclusion of their meeting yesterday. Chairman Powell citing concerns over what tariff inflation might be, despite the fact that we're seeing an erosion in fundamental U.S. economic activity. I really don't buy his claim that wages are holding or are higher. I just don't see that myself, but I'm not the Fed chairman. I do think the Fed will be forced to cut rates, and perhaps sharply going forward. But for now, we've got the 2-year Treasury yield continuing to edge higher. The 10-year Treasury yield is holding in an uptrend as well, but not quite as high. The 2-year is where the market thinks the Fed will go. Right now, the federal funds rate's about 4.3%, and the 2-year Treasury is about 3.9%, which would indicate 1 or potentially 2 cuts going forward. And that's what most market analysts are expecting. I think by the time the Fed's done cutting, we'll get to 4 or 5 cuts in the next 6 to 9 months. That's just my opinion. In the physical arena, we have the most popular gold bullion coin available at the lowest premium we've offered in years, just $49 over spot. We're seeing more sellers than buyers in the marketplace. We're able to edge our premium down on the backdated 1-ounce gold eagles, the most popular bullion coin in the U.S., to as low as $49 over the gold price. These are a great deal at this price. If we can help you with them, please let us know. We have Canadian silver maple leafs left at just $2.99 over spot. We're almost out of them. Once these are gone, we'll probably raise this price 25 or 50 cents an ounce, so you can save a little money here on a sovereign minted silver coin. And I'll let you in on the fact that we have also dropped the premium on our junk 90% silver to 0. So if you're interested in bags of 90% silver dimes or quarters, we have them available now at their melt value. For only the second time we've ever been able to offer 90% junk at melt. This is a low premium for physical silver. And in the vintage U.S. gold market, we have the ever popular $20 Saint-Gaudens in near gem condition, MS64 condition, at $100 off normal pricing today. The 2 top grading services, PCGS and NGC, have graded a cumulative total of just under 700,000 total coins for all dates and mint marks, going back to when they started counting their grades in 1986. So over the last 29 years, for all dates and mint marks, PCGS and NGC have graded under 700,000 total coins. And in the immediate national marketplace, there may be a couple hundred around at any given time. So these coins are a great value at the current price, which is a premium of just 7% over their intrinsic metal value. The 10-year average premium for these coins is 24%. So if you want to own physical gold at a premium that's just a little bit higher than common modern gold bullion coins, that'll give you some leverage to the upside when demand in the physical market is better, or perhaps some insulation to the downside if the gold market should take a correction, which I don't think is that likely. These are an incredible value today for a 100-year-old vintage U.S. coin in near gem quality condition. So that's our update. With regard to this Israeli-Iranian conflict, I think Israel is going to continue to do exactly what they have done since they were attacked by Hamas on October 7th, 2023. They decapitated the leadership, and then they decimated Hamas's ability to strike back. And then they did it in Lebanon. with Hezbollah. And now they're also going after the Houthis in Yemen. And since Syria fell and the Russian-placed air defense systems were taken out almost immediately by the Israelis, that was a way that Russia could help to protect Iran from an Israeli air attack. When Syria fell, the first thing the Israelis did was they took out those Russian-made air defense systems at the Syrian-Israeli border. We should have seen that as a warning sign that this strike on Iran was coming, because now we know that they clearly have been planning it for a year. And I think they're going to continue to do exactly what they've already done: decapitate the leadership to the best of their ability and neutralize their opponent's ability to strike back. And I don't think that this conflict will end until Benjamin Netanyahu is satisfied that Iran can't come after Israel in the future in any way, shape, or form at any time soon. And when these conflicts arise, things can go sideways. We'll see what happens. Right now, of course, we're all waiting to see whether the other shoe is going to drop. And that shoe, of course, is a 30,000-pound U.S. bunker buster bomb. Time will tell. So please, let's pray that this conflict can end quickly and without spreading further. Good luck to you all out there. Thank you so much for your time today.